It's kind of crazy to think that a single app, just one app with a cool design and this big promise of free trades, could turn millions of people into day traders and, well, completely shake up the entire stock market. So let's get into the story of how that all went down. So this is really the big question, right? How did one app, this little startup, go up against a 100-year-old industry and win? And not just win, but totally change the game, who gets to play and how they play it. That's what we're going to unpack. Okay, to really get a sense of how big this is, just look at this number, 20%. Let that sink in. Right now, on any given day, about a fifth of all the trading happening on the stock market, it's coming from regular people like you and me. Not the giant hedge funds, not the big banks. That is a huge power shift on Wall Street. And yeah, it all kicked off with one deceptively simple idea. All right, let's rewind a bit. Let's go back to the beginning and see how this whole trading revolution actually got started. So, picture this. It's 2013. Robinhood hits the scene with this, honestly, pretty radical promise to democratize finance. And their secret weapon? Zero commission trading. Back then, Wall Street kind of just laughed it off. But fast forward to 2019, and nobody was laughing anymore. The big players, Schwab, E-Trade, they were forced, literally forced, to drop their own fees just to stay in the game. The revolution was on. And the difference was just night and day. Think about the old way. You had these super complicated, clunky websites built for professionals, and you'd get hit with a fee, maybe $7, even $10, just for one trade. Robinhood just wiped that all away. Suddenly, it was free. And more than that, using the app felt as easy as scrolling through Instagram. So, what happened? An absolute explosion of users. Get this, in the first quarter of 2020 alone, Robinhood packed on 3 million new accounts. The barriers to investing weren't just lowered, they were completely bulldozed. But here's the thing, it wasn't just about the price, it was about how the app felt. See, this is the key. Zero fees, that was only half of the story. The real stroke of genius behind Robinhood was how they made trading feel less like some boring, complex financial thing and more like a super addictive game on your phone. And this is where it gets really clever. From a design perspective, the whole app was built for that little dopamine hit. You make a trade, boom, digital confetti explodes on your screen. Your phone buzzes with a push notification. You can buy just a little slice of a super expensive stock, deposit money in a flash. Everything was designed to make it effortless and, yeah, let's be real, pretty addictive. And did it work? Oh, yeah, it worked like a charm. You had this whole new generation of younger folks, many of whom had probably never even thought about buying a stock before. Suddenly, they're trading from anywhere. The growth, especially in that younger demographic, was just off the charts. Okay, but we've all heard the saying, right? There's no such thing as a free lunch. So if millions of people are trading for free, how in the world is Robinhood making any money? Well, this is where the story takes a turn and gets a whole lot more complicated. The answer comes down to this kind of wonky-sounding term, payment for order flow, PFOF. It's the business model, a really controversial one that the whole free trading universe is built on. And here's the mind-bending part to wrap your head around. On an app like this, you're not really the customer. Your trade itself is the product that's being sold. Okay, so let's break down how this money trail works. Step 1, you decide to buy a stock and hit the button in the app. Simple enough. Step 2, now you might think your order goes straight to the New York Stock Exchange, right? Nope. Instead, Robinhood bundles it up and sells it to a giant high-speed trading firm, a market maker like Citadel. And step 3, Citadel actually executes your trade for you and pays Robinhood a tiny fee for the privilege. Why? Because they get to see millions of these orders and can make money on the tiny gap between the buying and selling price. We're talking fractions of a penny, but when you multiply that by millions of trades, it adds up to a lot of money. That's the hidden cost of free. And this is where things get messy. Remember the whole GameStop saga when the market was going absolutely haywire? All of a sudden, Robinhood slammed the brakes and restricted trading on some of those stocks. The backlash was huge, and it forced everyone to ask a really uncomfortable question. Who is Robinhood really working for? The regular people using the app, or the powerful Wall Street firms buying their trades? So you take this super easy access, you mix in that addictive game-like design, and then you add a literal army of millions of new traders. What do you get? You get a perfect storm. And that storm gave birth to one of the craziest phenomena in modern financial history, the meme stock. And of course, we have to talk about the king of all meme stocks, GameStop. In the middle of 2020, you could snag a share of GameStop for, wait for it, about $4. Just $4. This was a company that Wall Street had basically left for dead. The smart money was betting it would go bankrupt. But then, something incredible happened. This massive group of retail traders, a lot of them organizing on places like Reddit's Wall Street Bets, decided to pile in, all at once. And just a few months later, that $4 stock peaked at over $400 a share. This had nothing to do with traditional investing. It was a full-blown cultural movement. And look, this wasn't just a feeling people had. Researchers actually went back and studied it, and they confirmed what everyone kind of suspected. The trading that was driving these stocks through the roof was totally disconnected from how the company was actually doing. It was all about hype, memes, and, for a lot of people, a chance to stick it to the Wall Street establishment. But if you need one last, truly mind-blowing piece of data to show you their power, here it is. Scientists looked at the data and found something wild. On days when Robinhood's app went down, when it had outages, the crazy price swings in those meme stocks actually went down. The market literally got less chaotic when this one group of traders couldn't access it. That's influence. Okay, so we've seen how this one app basically rewrote the rules of the market. But the big question is, what does all this mean for you, for the individual investor trying to navigate this new landscape? All right, so here are a few key takeaways for navigating this new world. First, you just have to know that some stocks can go on these insane roller coaster rides based on nothing more than social media hype. So you've got to ask yourself, is this thing moving because the business is solid or just because it's trending? Always, always do your own homework. And maybe the biggest thing, try to resist that urge to trade all the time just because the app makes it so easy and frictionless. At the end of the day, the Robinhood effect leaves us all with this one big important question. Look, tearing down the barriers to the stock market, that's a good thing, for sure. It's opened the doors for a lot of people. But the way these tools are designed encourages us to trade more, not necessarily to trade smarter. So the question you have to ask yourself is, are you trading smarter or are you just trading more?